Index funds, mutual funds, and ETFs are common terms you will hear people mention. But what are the differences between them, and why does it matter? Let's tackle index and actively managed mutual funds first. A fund means a collection of capital, which essentially means money coming from different investors who have all invested in a particular security, which means a tradable financial asset like a stock. In index funds, these securities are a specific list known as a market index. For example, the top 500 companies in the United States, known as the S&P 500. This is the same for any other market in the world, or any time that there is a particular set of securities that are being invested in. Index funds aim to match the market. Actively managed mutual funds, on the other hand, are made up of a changing list of securities that get selected by a manager. Imagine it like a bouncer or security guard working on a door. In the index fund analogy, only securities on the list are allowed in, while in active mutual funds, the bouncer selects who comes in. So why is this difference important? Index funds tracking things like the S&P 500 are designed to follow the market. So if the market as a whole goes up, so does the value of your investment. They are considered a passive investment because the securities are automatically selected. So as the top 500 companies in the United States changes, the index funds change to reflect this automatically. Active mutual fund securities are selected with the hope of outperforming the market. But since these are actively managed, the manager selecting which securities get into the fund needs paying. Therefore, the fees are significantly higher. The real kicker is that in most cases, index funds actually end up outperforming active mutual funds. Over a 15-year period from 2001, it was shown that around 90% of active mutual funds failed to beat the S&P 500 index fund returns. ETFs, or exchange-traded funds, are securities that track an index, sector, commodity, or other asset, but can be bought and sold on an exchange at any time of the day like a stock, whereas index funds can only be traded at certain times of the day. Overall, whoever is offering the ETF will pick different securities such as the bonds, stocks, gold, oil, and put them all in a basket. Then that basket will be divided into shares that you as the investor are able to purchase. Both index funds and ETFs usually have very low fees because they are both passive, but there may be fees associated with the more frequent trading of the ETFs. Also worth noting is that the cost of entry for ETFs is lower because lower minimum holdings are needed. All in all, index funds and ETFs are now a very accessible and cheap way to invest in a variety of different securities without paying a fortune in fees. Even Warren Buffett has previously recommended an S&P 500 index fund for the everyday investor. If you enjoyed this video, please leave a like and subscribe so you don't miss out on future videos.